Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to Jamie Constable of Singers, one of the UK's finest capital markets experts. So welcome, Jamie.
Hi, Paul. Great to be on again.
I need your help today, I'll tell you. With the immense amount
I might need yours. I mean,
with the immense amount of volatility, not least in Downing Street only an hour ago with Boris Johnson deciding to resign. But also we've had a terrible start on the stock markets around the world, with the AIM index now almost 30% down year to date, and the S&P 500 sort of bumping up around about 19-20% fall as well. So putting that together, given we've had a reset in valuations, what's your sort of view on equities for the rest of the year?
Well, it's interesting, isn't it? Because the S&P, that's the worst start to the year since 1970, I think. So the FTSE, of course, looking at the UK, the FTSE had a great start, massive outperformance, up 2%, only down 2%. So, but the mid and small caps, which is obviously you and mine and a lot of the viewers kind of where they like to play, is being down. Yeah, absolutely carried out, just like those US markets. So value coming through. Chatting to some of the kind of clever guys out there and stuff like that as well. I mean, the thought of it now is that we've had the derating. Now, will we now get the downgrades? And we've had a smattering of those already. You know, some stocks warning, particularly in the consumer side of the market. But they're not all going to warn, and the market looks forward. So the point is now we've had those big corrections, 20% plus. Let's be honest, the US was much more overvalued than the UK. The UK per se was not anywhere near as more overvalued, but the mid and small caps have been absolutely hammered. Partly is because of that UK consumer exposure, which obviously UK domestic scene still looks really tough. I mean, I don't know what confidence is like after what we've had over the last 48 hours, but maybe it picks up again. Maybe we get a rally in sterling once we get a new prime minister. But even you say Johnson's gone, but he's now saying he might stay for 3 months. God knows what he might try and get up to in those months. So we kind of hope that there isn't a wrecking ball going around while that happens. But I would hope that sterling will rally. So that kind of there's a lot of those UK small caps that might be buying internationally will start to get a bit of ease to the playing field from that point of view. And we should get a bit more kind of confidence for people buying stocks again on that in the smaller and mid-cap indices. So
what about just on that one? I mean, when you talked about the Forex, because obviously that makes a big difference. If you're importing and the sterling down, that's obviously against the dollar. It's a bit of a nightmare. But equally, if you're exporting, particularly to the US or dollar-denominated countries, you must be having a bit of a barnstorming year.
Well, yeah, that's partly why the FTSE's done so well as well, of course, because a lot of the FTSE's earnings are dollar-related, and they'll be converting back those dollars at $1, well, $1.19, $1.20 now. So obviously that's a big boost to their sterling earnings. But competitiveness is more important, of course. It's about being competitive. The issue the UK has, of course, is that industry is 10% of the economy. I mean, we're a services economy at the end of the day. And since Brexit, love it or loathe it, our exports have not actually been doing quite so well. And Europe's is a very important part for those Brexit. On that note, of course, we've got the euro and sterling competing to be almost the weakest currency against the dollar. And the euro is starting to win now, which is quite interesting, which is obviously they've got their own problems there with being close to Ukraine and everything that's going on there. So I think sterling, hopefully from now, rallies a bit. That favours, I would hope, more the mid-small cap end of the market because they tend to be buying more rather than selling more. If we look at it from that point of view, and doesn't favour the FTSE so much if you get a sterling rally. So in terms of that asset allocation, we hopefully get more coming down to those mid and smalls.
Yeah, I think sterling is going to rally if we start seeing any improvement on the zero growth we have on GDP. If that can tick up to more positive, perhaps follow the States at 1 or 2%, then we'll see a big pickup in the pound, I think, because a lot of traders have been betting shorting it for the whole of the year because the GDP forecasts have just been going down. Anyway, what seems to be sort of like the heart of this sort of like macro picture. And again, I want to pick your brains on this one, is the whole inflation story. And we've got sort of the US at sort of like, I think the last count was about 8.6% higher than actually, we said last time it might have reached peaks, but we were wrong there, and the market was. So 8.6. And I think the CPI in the UK is roughly around about 9%, just about, and then the euro is roughly, Europe is around about 8.6%. So everybody's about 8 or 9, but the UK is heading higher according to the Bank of England, to about 11% by the end of the year. So inflation's this big central sort of like gorilla we need to sort of like sort out. Now, the three areas that are key to resolving that is first and foremost the Ukraine-Russia crisis, which hopefully solve a lot of the energy problems and food. Then we've got supply chain bottlenecks. If we get a sort of like a resolution in China with its zero COVID policy, and then the final bit, if we don't get either of the two, we're going to get huge demand destruction and a recession. So let's pick through those. What's your latest view on energy and food prices, particularly in relation to Ukraine-Russia?
I think the interesting thing on oil is that we talk about oil being withdrawn from the global market, but is it really? I mean, Russia's selling its oil to China, to India. That oil is still going out into the global market. So, I mean, it's going out at a lower price, but that doesn't matter. And now we've got oil back around 100. If you got a resolution to Ukraine, I think we said it before, you'd have oil at 80 in a blink, but that oil is still going out into the market. It's more the gas issue, I think, for Europe that's the big issue. So it's not so much oil, it's gas. And the fact that he's choked down the supply of gas to Europe is a significant problem, because in Europe, they're not replenishing those coffers through the summer, which they need to do for the winter. And there's a new issue, isn't there, always at the moment in Europe at the moment, where they've just declared an extreme drought in northern Italy, the Po, the river there, tributaries of that have dried up. In France, the nuclear power stations use water from the rivers to cool the rivers are going too low, and they might have to turn down the power from the nuclear power stations because there's not enough water. Take that through to the winter. Hydroelectric's a big part of the power supply in France and other countries. If you haven't got enough water, you can't run the hydroelectric. So the issue we've got with energy, I think, remains an issue, just because the gas, now the drought in Europe in particular, it's going to be an issue. Maybe not quite so much in the UK, because we have got those import facilities for gas, not just from Europe, but we've got we bring it in from Qatar and stuff like that. But energy, I see remaining an issue. Food, I think the grain's starting to come out as well. You know, Russia's importing the grain from the areas they've taken over, and they're starting to sell that into the global market. Now, it doesn't matter who they're selling it to. It's the fact that they're selling it into the global market that's important, because that's supply coming into the market again. So you've seen the wheat prices come off. So I think the market now is starting to look to cool the top of inflation. And it's something we've spoken about at length before. And it's a really key view from our point of view here at Singers, as to where we see the rally in share prices starting to come from. Now, as you just said a minute ago, maybe we thought it'd be coming through in April, May, June, because you had the way the annualization works, you had these big three numbers coming out from last year in US CPI and PCE in the US. Now, it hasn't. Why? Well, we know why. Exactly what you just said, Ukraine. Now, if we look from now, the June dropout is quite a big number. I don't think we'll see a big drop. June, July, August, September, they're relatively low monthly numbers, 0.3s, 0.2s. So, but October, it jumped all the way back up to 0.8, 0.9 in the US. And that's going to drop out at the same time that I think we're going to see the benefits start to come through from what we've just been talking about, which is we set the energy price, the gasoline price in the US has started to come off now. Used car prices are coming off. Food prices, they probably stay up for a bit longer, but it's the direction that counts. And if we start to see that coming off, then the market will start to believe the peak in interest rates is in. And when we spoke last, that meant that people thought that would be the end of 2023. People now see the peak in interest rates as almost the turn of the year now in the US.
I saw actually, yeah, I saw it was last night on CNBC. It's been dropped from 4.1% a month ago to 3.4% was the peak in the Fed funds rate in March. In March 2023. So at the end of basically what we're talking 9 months time.
Yeah. So, and the market looks 18 months ahead. So now you're starting to see in the market. It's very difficult in the UK market at the moment because what's moving the market? Is it Johnson? Is it sterling? Is it peaking inflation? What's moving it? But let's flip over the Atlantic and let's go to the States. So what have we seen in the last few days there? Tech stocks have started to rally. Now, personally, I don't think because it's this big point we made here at the end, this is the end of free money. So we have to kind of go back 20 years to what drives markets. But you're starting to see growth stocks, quality growth stocks starting to outperform, which is what we've been talking about for a while now. When that CPI starts coming off, we might not have even gone into the downturn recession. Arguably, we might not really be in it, to be blunt. But those stocks will start to outperform. And we're starting to see it now. We've had a few days in a row now where the Nasdaq's outperformed the Dow and the S&P. The S&P's obviously got a lot of tech in still, so that helps that a bit more than the Dow. So we're starting to see that. Are we starting to see that in the UK? But it's still very, very volatile. I think it would be wrong to say we've got a kind of momentum behind stocks in that kind of at the moment. But we're starting to see markets looking for that peak in inflation, which is key.
So just coming back to the Ukraine, Russia, you can't see a resolution in the near term. You're seeing inflation peak in the autumn, interest rates in the Fed funds rate peaking at the end of Q1 and then coming
maybe a
down.
bit earlier. I think maybe a bit earlier. It might be. I think Fed fund. I think they will. Let's jump. Where do we see rates peaking? I would say 3 to 3.5 in the US. In the UK, I would say 2 to 2.5.
Okay, good.
So I think.
So your base case is that you can't see any near-term resolution to the Ukraine-Russia, and that will be upside if it happens. Now, just turn
upside, totally, yeah.
Okay, so turn into China, right? In terms of their zero COVID, that seems pretty unsustainable long term. It just depends on when they're going to start vaccinating their population with the US vaccines, or their local vaccines are able to develop such that they're adjusted such that they can cope with the Omicron, one or the two, and they start then blasting into people's arms. Otherwise, we're going to have this supply chain blockage. So what's your view on this sort of like zero tolerance policy of China?
Oh, the zero tolerance policy cannot work. I mean, they're just going to keep going like they are with rolling black shutdowns, vaccinations. They just announced another one yesterday, didn't they? Shanghai, yet again. It's just going to keep popping up and popping up and popping up. And they've got the problem there, as you say, that their vaccines aren't very effective. They'll reverse engineer one of the Western ones, obviously. They won't buy the Western ones. They could never do that. They come down for the leadership to do that would just be so huge. It's never going to happen, let's be blunt. So they reverse engineer it or something like that, and they'll start pumping that into people's arms, as you say. It's interesting. It's interesting, though, because you speak to companies like we do every day, the supply chains are easing. You look at the freight rates now, they peaked at about 18,000. You're back to 10 now. So the pressures are coming off. Look at the chip manufacturers. I mean, the chip manufacturer had a scare last week. The share prices started coming off because AMD came out and said we're starting to see consumer demand fall. Well, that's going to be great for the car OEMs, isn't it? Because they're finally going to push those cars out where you've got massive.
No. It's nothing to do with the chips which go into EVs and to cars. It's all to do with PCs and smartphone demand.
No. Sorry, but if demand's not going into that, the chip manufacturers will be able to put the car that have capacity to supply into other markets.
You need the designs.
No, but the wafers come from the factories, which is where they've got the problems.
The fabrication. Yeah, exactly.
Yeah.
I would agree.
If they're not going in that way, they'll be able to go that way. So that would help. Yeah. But what I'm trying to say is it's easing. Supply chains are easing. We speak to companies; they're all saying supply chains are easing, and that's obviously good news from that point of view as well.
Okay, that's fab. Okay, so what we've got then, essentially, if we don't see a resolution in Ukraine, Russia short term, and we've got supply chains easing regardless
That's
of whether
status quo, you see. The Ukraine is status quo. everyone's assumed that it's not going to get better, so that's
okay.
fine.
Okay, so then we come back to the third and final driver, which is what the markets, as you say, has been rightly pricing in, i.e. such that we're going to get a recession. It all depends on whether it's going to be mild or severe. And that has sort of like brought the US yield curve down roughly 70 basis points over the year, given the recessionary concerns, and as you rightly point out, boosted some of the tech stocks because those long duration assets have been valued at slightly higher. Okay, so now this is really the nub of it. Are we going to get are we going to get a recession, and what type is it going to be, and how severe and how long?
That depends on what the central banks decide to do. I mean, Powell's had a almost kind of conversion of the kind of mount kind of thing, from going from transitional to I'm going to defeat inflation. Almost
that was the Biden effect. That was
amazing how he switched there and done that. If he wants to really defeat inflation, he's going to another 75 and maybe another 75, and you will move into recession. How deep? I don't see the US being that deep. The Bank of England, I do despair a bit of the Bank of England, to be perfectly honest. I mean, when you have Bailey coming out and saying he's not worried about the exchange rate, you kind of go, well, hang on a minute. Have you not looked at the UK's propensity to import inflation historically? And down at these levels, you're importing it just hand over fist. I think they will wimp and they won't raise rates, so inflation will stay higher than we might expect it to. So that's why I'm saying 2 to 2.5. So I don't see on the back of that a deep recession, to be honest. I think we will get a shallow recession. We might escape without one. You never know, because what's the definition of recession? 2 quarters of contraction. I mean, you might be blipping around zero and might not actually get 2 quarters of contraction. So, I mean, I know the Bank of England is minus 1.25% in Q4, and then minus 0.25% for the whole of 2023. That's their forecast, which obviously shocked everybody when they came out with that. It was kind of, whoa, you really sure that's what we're going to see? That, I think, would require rates going up to, say, 3+ and stuff like that for that to happen. The flip side of the energy prices coming off a bit, of course, is that we might come to October and the energy price rise might not be as high as we may think it might going to be now. So instead of going, obviously it'll be higher, but for going from a really vicious circle, we start to get back into a little bit of a kind of virtuous circle. So some of those completely bombed out consumer stocks, people might say, actually, there might be a bit of a Christmas this year. It might not be so bad. So we're at this kind of turning point now, and it's crucial what happens next with the central banks on their moves on interest rates. At the same time, we've got record job vacancies still in the US, still in the UK. So you've still got quite a buoyant labour market. And I think Powell said, they're walking a tightrope at the moment, and you can go either way. If inflation starts rolling over, obviously the chance that you go the right way, or you stay on the tightrope, gets higher. And that's what markets are looking for at the moment. And why we're seeing, famous last words, a little bit more buoyancy over the last few days. But within what has been, let's be honest, 6 months of extreme volatility in the markets.
Okay, so essentially, I think your view is similar to the actual markets, and actually my personal one. We're going to get probably a mild recession in the US and maybe one in the UK, or one in the UK as well. Now, when it comes to sort of resetting the bar on pricing for equities, are we going to get a sort of recession in earnings as well? Because the S&P 500 for next year is pricing in at roughly around about $250 per share, and if you run that through, the last time I looked for the S&P, it was roughly around about 15.5 forward PE. Now, if you assume a long-term average of 16, 17 at times, then what the market's already saying is that it's ignoring most of the Wall Street analysts and already pricing in a downgrade to next year's earnings expectations of 250 to roughly around about anywhere between sort of 225 and 240. So we're looking at a 5 to 10% drop is already priced in, depending on what sort of sustainable multiple you look at. But if you look at it, it's sort of like a peak interest rates of 3.4% and then dropping down to roughly 2.7%, which is what it's pricing at the end of 2023. So if you run all that one through, there's already a reasonable reset of earnings in terms of, so we're expecting a mild earnings recession. Is that sort of chime with your view going forward?
The worry I have on the earnings side is a little bit more, I suppose, because inflation is looking more endemic in the system, particularly if you look at the UK. Any company you speak to, we're putting through price rises, we don't get any resistance whatsoever. And it's double digit. And you've got this big divergence between public sector and private sector wages in the UK, where you've got private sector wages are going up anywhere 7, 8, 9%. You saw Robert Walters yesterday talking about 25% inflation in white collar staff. That's typically where people are changing jobs, to be fair. And in the US, you've had quite a lot of wage inflation as well. So what we're seeing, we've had free money for 15 plus years. 2022, the mantra that you're going to hear is 2022 is the year that free money ends. We talked about it from the beginning of the year. And is that a new paradigm? It's not a new paradigm, it's back to the old paradigm. The power of labour over the companies it's tilted back again now. And if you're only going to get a shallow recession, that's not going to change. So margins are going to come under pressure, let's be blunt. Company margins have been at peak levels, and operational gearing works in two ways. If the power of labour is going up, you've had pricing power companies have been able to maintain their margins, but others are coming under pressure. If you do get a little bit of overstocking as well, like we saw with Target and companies like that, then I think margins will come under pressure a bit. So I do think that certainly bottom-up forecasts are way too high still, and we'll see that coming into the future.
When you say way, how would you how would you sort of like
the
measure
market
that?
As a hot? It's difficult because you got oil's going to get upgrades.
Yeah, I agree. So, I don't ask you easy questions, Jamie.
No. So it's difficult. It's probably 10 to 50, as you would say.
Okay.
10 to 15, yeah.
Because
I would say around, when you aggregate it all out. But for some companies, they're going to be seeing big downgrades, you see. So it's all about going through and finding, as we've talked about before, quality growth companies with little debt, because the free money has ended now. And banks are going to start getting a lot. You saw the Bank of England financial stability report. My God, we talk about, they seem to have woken up and blimmin' heck. I don't know what side of bed they got out.
Well, it's an instability report, isn't it?
It was, yeah. So you saw that. I mean, yeah, you're going to get pressure on those earnings. And you're going to get downgrades, and certain models that worked in an era of free money don't work in an era when there's a cost of capital. So we've got to work through all of that. So we're going to get more volatility, and it's going to be all back to stock picking.
Okay. Now, before we just go into sort of like a bit of the stock selection, etc., there's something which has been bugging me and bugging a number of investors. Is there anything else out there that's causing the markets an unknown? Because is there a blow up? Is there a bank contagion? Is there hedge funds having a problem? Is Bitcoin?
There's certainly been hedge funds having problems. We know that or funds, because the amount of volatility in credit markets. I'm going to have to pick a piece of paper up now, because if you look at bonds, so this is the first half, right? So the US 2-year started the year at 0.73%, peaked at 3.43%, and finished the first half at 2.95%. I mean, you go to the UK, 0.64 started the year, peaked at 2.28, closed at 1.82. That's the 2-year. And volatility just at those scales, and it's across the world. It's everywhere. It's not just it's not just US.
That's equivalent to Blackpool's Big Dipper on steroids, isn't it? In the bond market.
I mean, you can't have that kind of volatility without people's financial models being challenged. It's not possible. And bond market, having that amount of level of volatility in bond markets is, I mean, God knows, they're talking about standard deviation events. God knows how many standard deviation event that is. So yes, there's going to be people in difficulty out there. If we haven't heard that much about it, but there must be people having big problems within that. But the key for the financial system is the banks. We talk about the Bank of England Financial Stability Report. The banks' balance sheets are so strong because they've been so constrained from what they've can do, that I don't see the problems with the banks.
What about the Italian ones? What about the Italian ones and Credit Suisse and Germany?
They're all in a mess, the European ones still, yeah. To be fair, the Portuguese and that side of those kind of countries did sort themselves out quite well. But Italy is in a mess. I mean, I think that there are potential systemic problems in Europe, which is why the euro is now so weak. I read a report the other day where basically someone was saying, you just can't buy the euro, full stop. You cannot buy the euro. And you've got this whole problem of fragmentation, which, just to explain quickly for viewers on that, is, so now you've stopped QE in Europe, only just, like literally days ago, with rates still at -0.5%. We shouldn't forget rates are still at -0.5% in Europe. Is when Italian bond yields now can, because they're not buying them at the central bank, they can gap up. So we had in the last month, we had it over 250 basis points of differential between between the German and the Italian 10-year yield. It got back to about 1.870. It's back up to 200 again. But the ECB is saying they're going to come up with some anti-fragmentation system. Markets are going to challenge them on this. So I potentially see the left field problem coming from there. That's where I see the problem coming from. It's kind of, could it be disintegration of euro? I mean, Putin, arguably, is that what Putin's trying to do in the first place? Is that what he's trying to do? Break up the whole of Europe, because then he can kind of walk in and do what he wants. So that is your kind of left field, I think. If you have a loss of confidence, I mean, could you see something similar in the UK? I think maybe the change of, at the top will change that. But if you look at the current account deficit for the first quarter of this year, I mean, it was huge. The UK is completely dependent on overseas funding if that were to dry up. So that's where you're kind of...
Unless we do more QE.
Unless we do more QE. But I mean, the trouble is, you say
you're going to get huge devaluation in sterling if you do.
Yeah, you can't do more QE. But the left field, you never guess it. That's why it's the old economic adage. As soon as you start tracking a indicator or targeting an indicator, it becomes useless as an indicator. So it's kind of
yeah. Okay. So let's just move on. Just finalise. I know we're running short of time. Let's just spend a bit of on one really potential, very interesting area, which is the whole energy sort of transition. And I know Singer sort of covers one of the stocks is Avingtrans, which has obviously got a big nuclear exposure in decommissioning, life extension, and the new nuclear ones. And then obviously, I think you've also spoken to Ashtead Technology, which does subsea marine for offshore wind. And so let's just pick through those. Avingtrans came out with a pretty much in line year-end trading update and a positive outlook. Can you just take us through that one?
Well, I think what you've got with Avingtrans now, you've got orders are up year on year. Management are very conservative, excellent management who deliver. That's the kind of stocks you want in this market. Quality, record of delivery, and basically that, pricing power, etc. So you've got nuclear there, where they are certainly benefiting from extension of life. Now you've got new build coming through, because it's the only way we're going to solve the energy issue. Now, there's very little expertise globally on that. You have to be qualified for everything you do on nuclear. Avingtrans have got all the qualifications, obviously, because they're in extension of life. So that's a great business to be in, extremely valuable. And we all know what Avingtrans model is. You build it up, you buy it very cheaply from some businesses in trouble, you build it up, and then at some stage you sell it on for the next person to take to the next level. On top of that, you've got the medical division now, which is growing at pace. This is the kind of small kind of imaging business, which can do kind of limbs or babies or animals or stuff like that. That's growing at pace. There's a great deal there to advance that. So that's going to be an investor's window in the next 12 months, really, as to how they're going to create value from that. So great areas of the market to be in. Offshore wind, you just mentioned, which is not Avingtrans, let's be clear on that. But the contracts are now being let on that. People are putting those contracts out of Scotland, etc. Again, energy security is at the top of every government's agenda. They've got to do it. They have to move forward, because, as we just said right at the top, is Ukraine going to stop? Doesn't look like it now in the short term. And Putin has his hand on the gas valve as to whether Europe's going to have enough energy. So those are all great areas to be in. And I think, it continues to be a great area to invest.
Yeah, and I think it's just on valuation. If you strip out the cash, which is about 50p a share,
It's on Avingtrans, yeah, £4.
and even if they don't sell their sort of like their spare land, even if that's to stay with the actual business, if you run that on a PE multiple for this year, then he's looking at around about 14, just over 14 times.
14,
so it's pretty cheap if you strip out the cash.
We're looking at it on some of the parts, so So because that type of business, so you have to kind of look at it on that kind of view.
Yeah.
And of course, let's not forget for Avingtrans that M&A is a big part of their model. And what we've seen in markets in terms of the volatility typically throws up opportunities, doesn't it? So who knows? I don't know.
Yeah, they're sharp cookies, and I'm sure they're going to deploy some of that capital.
They'll be monitoring no end of companies, I'm sure. So at some stage, we'll get something coming through from that. And there's, it's those the type of companies that you want to kind of on your portfolio, because those will be the first companies that will bounce. And
then another one, which is obviously benefiting from that energy transition, given the rejuvenation of all things North Sea and particularly offshore wind with the Dogger wind farm and stuff like that, is a business that I think most investors haven't really heard of. It's Ashtead Technology. Yeah. And do you want to just talk through it? I think about a third of the business is to do with offshore wind, and the rest is sort of submarine. Well, sorry, basically, subsea type of equipment rental, robotics and servicing and stuff like that.
No, I'm no expert on that one, to be fair to you, Paul. There, sorry, but yes, it's got all the right drivers in terms of the markets it's renting into. The key is that activity is picking up for them. Activity picks up, demand picks up. For markets where you've seen subdued demand, it's a bit like, I don't know, look at Ready Northgate when they're on the rental cars that they put out there, or look at a car rental business at the moment. Try and rent a car. What happens to rates? I mean, I was being told that someone tried to rent a car in Ireland and they quoted £7,000 for a week. I mean, for a week to rent a car.
What were they renting, a Bentley?
No, that's just a normal car.
£1,000 a day. Wow.
Yeah, it's ludicrous because they can't get the new cars. You think about it, your rental business. So supply and demand works. I mean, there's no supply. There hasn't always been limited supply. And this is partly why the miners are so strong as well, to be honest. You think that we're going to go into a recession, that the mining stocks, which again are favourites of private investors because they've got great yields and everything like that, you think that, hang on a minute, we're going into recession, the copper price is down 18% plus year to date, probably around 20 now. It's rallied a little bit today, but why are the mining stocks going up? Well, because you haven't had, in this era of free money, you haven't had investment because there's no return on that investment. Now we're going, hang on a minute, we need to electrify the world, whatever it might be. Now people are going, okay, better buy some of these stocks, even though we might have a bit of a slowdown, because the prices, these commodities is going to go up again. And that's the kind of dilemma you've got at the moment on inflation, isn't it? Because we've had the perfect storm on everything going up with the restart of the global economy, flicking the switch from off to on has hit everything. But some commodities are going to still remain, prices will remain strong because you've got lack of supply. And certainly copper, how many new mines have been built?
Lithium.
Yeah, all these commodities.
Anything to do with EVs is going to carry on growing big time.
All these rare earth metals, there's been no supply coming on stream. So those companies, even if you have a slowdown, when if you had a recession, you'd expect to sell the miners, wouldn't you? Oh, recession, you've got to get out of the miners. Prices are going to crater. But there's been no investment. So people are sitting out there saying, we need to be in these stocks because they're secular growth stocks now.
Yeah, and just finishing on that Ashtead, I mean, I think if people want to have a look at it, it's about 13 times PE, and they just put a trading update out, and I think top line growth was 25% organic. So you're right.
And the VC placed a stock out, which was taken very well as well, didn't they? So
yeah. All right, brilliant. Well, I mean, that's been a fantastic whirlwind around the macro stuff because it's been absolutely just hugely volatile and very painful for myself and many other small cap investors this first 6 months. But it's good to know that actually the outlook in the longer term is going to be perhaps a bit more optimistic, even though we've got a short term, probably a bit more volatility to come.
I think we have. Yeah, I think the bottom line is I think we're nearer the end than the beginning. That's the bottom line now in terms of this market correction that we've seen. Valuations have come back a long way. we need to see the earnings season to see what the operational gearing of these businesses are. And different parts of the market will see it in different ways. I'm still quite cautious on the UK consumer, but for those secular growth, long-term overseas earners, great. It's time to start looking at them.
And as a final sort of $64 million question, who's going to take over from Boris Johnson?
I haven't got a clue. I think it should be, if you wanted my personal opinion, it's obviously not. I think it should be someone almost unknown who comes in and they can build up their reputation over 2 years, because I'm not really sure what kind of credibility anyone in the current cabinet can really have. But politics, who knows? Who knows? Who would have thought we'd have seen what we saw this week?
Yeah, I think as long as the new person can stabilise sort of like investor concerns in terms of particularly the uncertainty, maybe roll back short term some of the tax hikes we've had, just to give people a bit of extra breathing room, and try and get that confidence returning to the UK to jumpstart the GDP, which will improve the value of sterling, so we can all go on holiday and enjoy it rather than having to pay £7,000 to hire a car in Ireland. Anyway, thanks very much, Jamie. And again, look forward to touching base in a month's time.
Cheers.